Today's show is about a brokerage that set a new record for daily trades while somehow still missing on revenue. 4.37 million trades per day, every single day of the first quarter. That's Interactive Brokers, ticker IBKR. And the story behind those numbers is more interesting than the headline miss.
The first quarter of 2026 was genuinely complicated for IBKR. Record operating metrics, more accounts, more trades, more margin lending, but net revenues came in at $1.67 billion, short of the $1.74 billion estimate. And earnings per share, a penny light at 60 cents for 61 cents, expected.
So here's the tension. The operational flywheel is spinning faster than it ever has, but the financial headline, disappointed. The question we're going to answer today is whether IBKR is a business whose best days are ahead of it, or one that's hitting a rate cycle headwind that's harder to work through than the trade volumes suggest.
Worth noting the market context here. The S&P was down roughly 5% in Q1 2026, and the Mag 7 stocks fell even harder. That kind of volatility is actually fuel for IBKR's engine. More uncertainty means more trading, and more trading is exactly what this company monetizes.
Let me set the stage for everyone tuning in. Interactive Brokers was founded in 1977 by Thomas Peterffy, a Hungarian immigrant who literally built his own trading terminals when no one else would sell him direct market access. That contrarian technology-first ethos has defined this company ever since.
At its core, IBKR is an electronic brokerage platform. They offer trading in stocks, options, futures, currencies, bonds, and funds across 160 markets in 34 countries. The business generates revenue in two main ways: net interest income from sitting on customer cash and funding margin loans, and commissions on actual trades.
Net interest income is the big one. Think about it. IBKR holds roughly $169 billion in uninvested customer cash. They earn interest on that pile, and in a higher rate environment, that interest income is enormous. In Q1 2026, NII was $904 million.
The other engine is commissions. IBKR crossed $600 million in commission revenue for the first time ever in Q1 2026, $613 million to be exact. That's driven by DARTs, daily average revenue trades. More volatility, more trades, more commissions. It's a beautifully simple model.
The company serves roughly 4.75 million customer accounts as of Q1 2026, up 31% year over year. Those accounts hold $789.4 billion in total customer equity. This is a serious institutional-grade platform that has also become a destination for sophisticated retail traders globally.
The competitive moat is genuinely deep. IBKR built all its technology in-house from day one. They offer the lowest margin lending rates in the industry, direct market access, and a global footprint that most rivals cannot match. Scale advantages in both interest economics and commission pricing create compounding barriers that are very hard to replicate.
Peterffy still owns roughly 75% of the economic interest through IBG LLC, making this effectively a controlled company. He is known for saying he is hell-bent on increasing marketing spend, a rare aggressive posture from a man who built a fortune on cost discipline. The company is headquartered in Greenwich, Connecticut, with about 3,000 employees.
On the leadership side, IBKR is being led by President and CEO Milan Galik, who took the top job in 2019. But this is really a two-person story. Galik and Peterffy together define how the company operates.
Galik joined IBKR back in 1997 as a software engineer. He spent over 2 decades rising through the technical ranks before being appointed CEO. That background matters a lot. It means the person running the company understands the systems that generate the revenue at a fundamental level.
Thomas Peterffy, the founder, remains executive chairman at age 78. He holds an extraordinary stake in the business. When Peterffy talks, which is not that often, people listen. His comment about being hell-bent on trying to increase marketing spend was one of the most notable things said on the earnings call.
Galik is seen by most researchers as a steady, low-profile operator. He is focused on execution, platform reliability, and international expansion. His tenure has seen IBKR's mobile platform improve significantly and its international client base deepen. Not flashy, but consistent.
The dual leadership structure creates interesting dynamics. Gallic manages the day-to-day, while Peterfy sets the long-term vision and keeps the culture of radical cost efficiency alive. For investors, the key succession question is what happens when Peterfy eventually steps back entirely. But for now, the continuity looks stable.
Let's dig into the financials on IBKR because there is a lot here to unpack. Lana, take us through the Q1 2026 numbers.
Net revenues came in at $1.67 billion for the quarter. That breaks down into $904 million in net interest income, $613 million in commissions, and about $152 million in other revenue. The NII and the commission line are both growing double digits year over year.
But those numbers missed. The estimate was $1.74 billion. The gap was almost entirely in NII. That $904 million was solid, but rate headwinds from the Fed's trajectory meant the yield on all that customer cash was lower than the market had modeled. The commission line actually beat.
Adjusted EPS came in at 60 cents per share. The estimate was 61 cents. A 1 cent miss. Year over year, that is a 22% increase from the 49 cents IBKR earned in Q1 2025. So, on a growth basis, this is a strong quarter. The optics just looked soft against the street's number.
What is remarkable is the pre-tax income. IBKR generated $1.288 billion in pre-tax income on $1.67 billion in net revenues. That is a 77% pre-tax margin. Think about that for a second. $7 out of every $10 in revenue drops to pre-tax income.
That margin profile is the result of extreme operational leverage. Non-interest expense was only $381 million for the quarter, essentially the cost to run the entire global platform. The reason the net income looks much lower at $267 million to common shareholders is the partnership structure and minority interest allocation.
On valuation, the public float is trading at around $35.4 billion. That puts the price to earnings on trailing 12-month EPS at about 34 times. The price-to-sales ratio is 5.6 times on TTM revenues. The price-to-book comes in at 1.67 times book.
The balance sheet is pristine. IBKR holds $5.1 billion in cash, with essentially zero corporate debt, $12 million. Net cash position of $5 billion. Total assets are $218 billion, but the vast majority of that is customer assets, margin loans, securities, and cash held on behalf of clients.
Customer margin loans hit $86 billion in Q1 2026, up 35% year over year. That is the collateral IBKR is lending against. It is the asset that generates a big chunk of NII. More accounts means more margin balances, means more interest income. The flywheel is compounding.
Customer equity reached $789.4 billion, up 38% year over year. Uninvested customer cash was $169 billion, also up 35%. Both of those metrics create the raw material for net interest income generation, and both are growing faster than revenue.
And the DARTs number, 4.37 million daily average revenue trades, is a record, up 24% year over year. The first quarter had the S&P down 5% and high macro uncertainty, which translates directly into trading volume. IBKR's model essentially gets paid more when markets are volatile.
Overall, Interactive Brokers' financial health is solid. The balance sheet is debt-free, the pre-tax margin is best in class at 77%, and the operational metrics are all pointing in the right direction. The miss on NII was real, but manageable, and the business fundamentals look stronger than the headline suggests.
Let's see how the research community is reading this one.
What does Wall Street actually make of this quarter? The picture is fairly divided, and it reflects a genuine debate about whether the miss is structural or cyclical.
About 50% of researchers covering IBKR have it as a buy or overweight. The other 50% are neutral. Nobody has a sell on this name. That distribution tells you something. This is viewed as a quality company with a near-term overhang, not a company with structural problems.
Goldman Sachs and Barclays both raised their price targets following the earnings report, citing the record DARTs and the commission revenue milestone as evidence that the operational flywheel is intact. Goldman's target is now $88. Barclays is at $85.
On the other side, Jefferies cut their price target by $10, flagging the NII miss as a potential structural concern rather than a one-time headwind. They are not selling the stock, but they believe the rate sensitivity on that interest income line is bigger than the market has priced in.
Keefe Bruyette kept their market perform rating, presenting a balanced view. They see the record volumes as an encouraging sign, but they share concerns about NII compression if rates move lower. The average price target sits around $82, suggesting modest upside from current levels.
So this is a stock where operational momentum and valuation are having an argument. The business is performing exceptionally well on volume metrics. But when NII underperforms, the earnings power is more exposed than the headline DART numbers would suggest.
Let's work through the bull case and bear case on IBKR and let the data speak.
On the bull side, start with what's undeniable. 4.37 million daily average revenue trades is a record. That's not a lucky quarter. It reflects IBKR's technology advantage in attracting sophisticated traders globally. When markets get volatile, these traders migrate toward the platform that executes fastest and cheapest. That's IBKR. The bull case on growth, 4.75 million customer accounts, up 31% year over year. The international expansion is accelerating. Each new account adds to the long-term NII and commission base regardless of market conditions. IBKR is capturing market share globally in a way that builds durable, recurring revenue. On the bull side, the margin lending book is the hidden lever. $86 billion in customer loans, up 35%. Every dollar of that balance generates interest income that's extremely predictable. As accounts grow, margin balances naturally grow. This is the kind of compounding asset base that can sustain NII, even if rates drift lower. Geographically, IBKR is one of the few electronic brokers with a genuinely global footprint. 160 markets, 34 countries. International clients now represent a growing share of the account base, and some of those markets have much less mature brokerage infrastructure. That's a multi-year runway for account acquisition without fighting for saturated domestic share. The technology moat is one of the strongest arguments for the long-term story. IBKR built every system in-house. Their execution quality, their margin lending operations, their back-end plumbing, all proprietary. That means no licensing costs, no vendor dependencies, and continuous compound improvement over decades. The balance sheet is genuinely pristine. No meaningful corporate debt, $5.1 billion in cash, and the operating model generates cash efficiently. Peterfy has mentioned increased marketing spend as a priority, which suggests he's willing to invest in growth from a position of strength.
The bear responds on NII. That rate sensitivity is real and potentially structural. In Q1 2026, NII was the primary reason revenues missed estimates. Not volumes, not commissions, but the yield on customer cash. A Fed rate cut cycle would compress NII directly, and given that NII represents over half of net revenues, that's a meaningful earnings risk. The bear case on valuation. At 34 times trailing earnings, IBKR carries a meaningful premium to traditional brokers. If NII contracts due to rate cuts and DARTs normalize in a lower volatility environment, the earnings power could compress significantly, and that multiple would look very stretched against a lower earnings base. There's a volatility dependency risk embedded in the business. The 77% pre-tax margin is extraordinary, but it's partly a function of an elevated activity environment. In calmer market periods, DARTs and commission revenue can fall meaningfully. The model is structurally more profitable when markets are in motion. The bear acknowledges the account growth but raises the concentration risk angle. Thomas Peterfy controls 75% of the economic interest. His preferences dominate strategy, capital allocation, and culture. If a succession decision surprised the market, the uncertainty premium could be significant. The fintech threat is real. Zero commission trading has become the expectation for retail investors. While IBKR has differentiated on institutional features and margin lending, the retail end of the market keeps getting more competitive. The question is whether IBKR's high-value customer profile insulates it from that pressure over time. Regulatory risk is worth flagging. IBKR operates in 34 countries and offers margin lending, options, and crypto-related brokerage services in international markets. Regulatory tightening on any of those fronts, particularly on margin lending or crypto, could require capital allocation shifts or business model adjustments.
That's the full picture on both sides. IBKR is a genuinely exceptional business. Best-in-class margins, record volumes, and a compounding account base. The risk case is not about survival. It's about whether the multiple is justified when NII is rate-sensitive and DARTs are volatility-driven. A reasonable debate either way.
Let's see how IBKR stacks up against other names in the brokerage and financial market space.
Compare it to Charles Schwab first. Schwab trades at a price-to-sales ratio of 4.2 times, cheaper than IBKR on that metric. Schwab is 10 times larger by assets under management and serves a more retail-focused client base. IBKR's premium over Schwab reflects its faster growth rate and higher margin profile.
Robinhood is the growth story in this space. Their price-to-sales ratio is 7.8 times, significantly higher than IBKR, on revenue growing around 35%. Robinhood is earlier stage and carries more execution risk, but it's the name that's most directly fighting for the next generation of retail traders.
CME Group is a different business altogether, an exchange operator rather than a brokerage. But it's relevant because some investors see exchange-like economics in IBKR's model. CME trades at 12.5 times price to sales, reflecting its regulatory moat and near monopoly position in futures clearing.
IBKR's 5.6 times price to sales sits in the middle of that range, cheaper than high-growth fintech names, more expensive than large-cap traditional brokers. That spread seems justified given IBKR's 17% revenue growth rate, its best-in-class margins, and its international expansion runway.
The margin comparison really stands out. A 77% pre-tax margin is extraordinary relative to any of those names. Schwab's pre-tax margin is in the 20s. Robinhood is barely profitable. CME is high margin but concentrated in one business line. IBKR earns structurally more per dollar of revenue than almost anyone in financial services.
Let's take a look at how things are positioned in the options market for IBKR, then we'll cover insider moves.
The put-to-call ratio is sitting at about 0.85, a slight bullish lean in options positioning. IV percentile is around 42, which means implied volatility is not particularly elevated relative to the past year. Options are not especially expensive right now, which could make them attractive for positioning in either direction.
There was some notable call activity post-earnings. A sweep of 2,500 contracts hit on the July 85 strike at 185 mid. That's a bet that IBKR pushes toward or through 85 by summer. The largest open interest cluster on the put side is at the $80 strike expiring in May.
On the insider side, the big story is Earl Nemser, the vice chairman. He sold $30.7 million worth of shares across 8 separate transactions in March and April of this year. That is a significant dollar amount for any insider.
Director Lawrence Harris also sold $3.8 million in April. There were no recorded open market purchases in the same period.
Both of those sales appear to be pre-scheduled under Rule 10b-5-1 plans, which means the decisions to sell were made well in advance and are not necessarily a signal about near-term company outlook. Nemser still holds a substantial position post-transaction. The selling is large in dollar terms but consistent with planned portfolio management.
Before we get to our final take, a few key risks and watch points. The NII rate sensitivity is the number one thing to keep an eye on. Any shift in the Fed's trajectory has a direct and measurable impact on IBKR's largest revenue line.
Let's get to the bottom line on Interactive Brokers.
The Q1 2026 report is a story of operational excellence, meeting a rate sensitivity overhang. Record DARTs, record commission revenue, 31% account growth. The flywheel is clearly accelerating. The NII miss was real, driven by rate headwinds, but it does not change the long-term trajectory. IBKR is building a bigger and better business with every passing quarter.
The key metric to watch going forward is the relationship between DART trends and NII. In calm markets, DARTs will compress. That is expected. The question is whether account growth and margin loan compounding can sustain NII even if rates drift lower and trading volumes normalize. That is the number that determines whether the 34 times multiple is justified.
We always close with a quote that captures what makes a company tick. For Interactive Brokers, it has to be from the man who built it. Thomas Peterffy once said, "What is important is for us to have the best technology, the best prices, and to be the best at what we do."
That is basically the entire IBKR strategy in 3 sentences. Not the best marketing, not the biggest ad spend, just relentless focus on execution and cost structure. Almost 50 years later, that philosophy has produced one of the highest margin businesses in all of financial services.
And you can see it in the numbers: 77% pre-tax margin, best-in-class margin rates for customers, technology built entirely in-house from the ground up. No corners cut, no shortcuts, just compound improvement over decades.
It is a reminder that the companies that endure in financial services are not usually the ones with the loudest marketing campaigns. They are the ones that do the hard operational work so consistently that switching away becomes genuinely painful for their customers.
That's going to do it for this episode of Charged Alpha, our deep dive into Interactive Brokers. If today's breakdown gave you a new framework for thinking about electronic brokers and market structure businesses, share it with someone who might find it useful.
And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out.
New episodes drop every week. We go deep on one company at a time, the fundamentals, the risks, the full picture, so you can build a sharper view of any name you're following.
Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.